Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Matt Rowe, who's the Managing Partner and Chief Investment Officer of Headwaters Volatility. And we're going to talk about managing long vol positions. And Matt, it could not be a better time for you to join me at market site. And for those of you catching this on the replay, it's February 25th. We've seen 2 days of actually prolonged volatility, not really the buying the dip mentality over the past couple days.
Yeah, I think there's been some overwhelming forces in the market, some forced risk reduction and roles in products like the VIX and some others from CTA space and other systematic strategies that once you hit certain triggers, they're sort of forced to de-risk, and that's accelerated a little bit. I think what we're really looking at, though, is the product of people realizing that they've been selling vol at levels that don't make a whole lot of sense. So in this world where everybody's starved for yield, selling volatility has been a very popular yield enhancement strategy, and days like this, the past 48 hours, cause you to have a little reality check in your risk management.
And what's interesting, we saw that in February, not too long ago. We'll get into that a little bit more, but you manage long vol allocations for investors. Tell us more about that and actually maintaining long vol trades, because really over the past year, it's been hard to be long vol.
Yeah, so one of the hardest things about being long vol is, first of all, most investors come into the conversation with a preconceived idea that owning volatility is a directional trade, number one, that it's only a down trade, and number two, that it's going to cost a whole lot of money. The reality of the situation is it really depends on how you implement the trades and set expectations at the outset. So what we really try hard to do is to educate our investors and set expectations that are realistic about the cost of carrying these positions, the payoff in scenarios like the last 48 hours. And I think if done in a transparent way in markets that are sort of suppressed from a vol standpoint, which we've seen over the last year, it's a pretty good starting point for days like today.
Yeah. What about investors getting compensated for taking on this risk?
Yeah, so there are a number of different measures for whether investors are actually being compensated for selling vol or buying it, but more to the point of overwriting calls and things like that. The SIBO publishes an overwriting alpha score, which has routinely been negative for a while, basically suggesting that if you're overwriting at these levels, you're giving away some edge. Most of the yield enhancement world that's been selling volatility doesn't really care what the implied vol is. They're more worried about dollars and basis points. And that actually is where the opportunities exist, in my mind. When you get two different market participants that are trading the same security with different utilities, it doesn't need to be a zero-sum game. It doesn't mean that the sellers of vol are having a great day right now, but they're doing it for purposes that are slightly different than the way we position it, and it's been a really interesting intersection in the market of late.
Yeah, it certainly has been, because there's an old adage, selling vols like picking up nickels in front of a steamroller. I think it's a little bit flippant at the end of the day. There is a purpose for it.
There is.
Like yield enhancement strategies that you had mentioned.
Yeah.
But what are some common themes that you're hearing from investors?
So it depends on the investor type that we hear about. There are certain liability management programs, such as pension funds, endowments, insurance companies, that have a relatively long field of vision for what they do, how they invest, and most relevant to volatility, how they will reallocate. So for somebody like that, it's most interesting because they could say be 80% equities, 20% fixed income. So they know if the market's up 10%, they're going to be overexposed to equities, and if the market's down 10%, they're going to be underexposed to equities. They are a natural seller of products like strangles, like a call and a put around the market. So if the market goes nowhere, they can gather some premium. If the market moves higher or lower, they start moving into an automatic rebalance. It fits really well with their risk profile. I think where we get into dangerous territory is when some market participants start selling volatility at prices that don't make a whole lot of sense just to generate additional carry. In those situations, if there isn't a natural rebalance mechanism or acceptance of what happens in the wings of those trades, the P&L can get pretty nasty really fast.
Yeah, it was interesting because February 19th, just a week ago, we were sitting at all-time highs, and the narrative was, okay, market complacency. Is it ignorance, or is it just the market is strong enough where it can handle these shocks? But apparently not. I mean, we were at all-time highs, stretched valuations by virtually every metric. It took one thing. One thing, and we're down almost 1,000 points in 2 days on the Dow.
Yeah, and I think that one thing is the impact of something like the coronavirus on assumptions of growth, which was really a important pillar in the thesis that stocks might be cheap. If we were going to experience some sort of growth, if we were going to see some sort of beneficial inflation, that could carry the equity market higher. But I think with the 30-year at 183 right now, roughly, and the Fed's expectation or hope for inflation is 2%, and this virus outbreak certainly not being good for global growth prospects, I think a lot of people are really concerned about where we sit from a valuation
I also think if you look at it from a consumer perspective as well, 2019 was really based on the strength of the consumer.
Yeah.
Conferences are getting canceled.
Yeah.
Right? People are not going to restaurants, and that's the
Yeah.
service economy, which has really been a big contributor to the employment numbers that we've seen, which are fantastic in their own right. When layoffs around that, or them not putting money back into the system, which is such
Yeah.
a big contributor to GDP, it's not necessarily just earnings for the next quarter or two.
Yeah.
I think we need to look at this more beyond just a day or two of volatility.
I agree, and I think things like United Airlines canceling their guidance because they really have no visibility about what this is going to mean. And anecdotes that I hear from people that I deal with in the market around Midwestern industrial companies not being able to hire people because they're taking jobs at Target or Walmart or Home Depot or things of that nature. It doesn't take a whole lot to really throw this into a bit of a disruption from a growth and the whole story of growth and an employment perspective. So I think people are rightfully a bit concerned, and when you think about, relatively speaking, where we are, we've pretty much, just as you mentioned, come off all-time highs. We're down 1,000 points in the Dow, but we're still pretty close to all-time highs, and valuations are still
I think
stretched.
even with the past 2 days of selling, the Nasdaq Comp and 100 are still up on the year. It's only not even 2 months into the year, so the swings have just been extreme on either side.
Yeah, and I would argue that most investors look at the risk-free rate as a combination now of Fed funds, LIBOR, and beta. I think most people are leaning on some form of beta, whether they like it or not, because they've been forced to buy low rates.
Yeah. All right, Matt, thanks so much for joining us at MarketSite. And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.